Is the real estate market crashing? This is a question that a lot of people have and very few people know the exact answers to. In this video, I'm going to take a deep breath with you and give you some actual facts of what's happening in the market and give you some tips and tools to take with you to take advantage of whatever the market throws at you. YouTube and social media are known for giving out these outlandish hooks or these outlandish thumbnails that tell you that the sky is falling, because if you see that, you get scared, and when you get scared, you click the button and you watch the video. The market is not as strong as it could be, but it is not as bad as they're telling you it is. So let's dig in at what's actually happening, and then I will tell you about what you can do to take advantage of whatever happens. If you appreciate the normal, non-fear-mongering candor, hit that like button. And we'll see how many of you actually don't like it. Let's set some foundational groundwork concepts and talk about what actually causes a real estate crash. One of the biggest factors of a real estate crash is the unequal relationship of supply versus demand. And this is exactly what happened in 08. There's an overbuilt supply with a minuscule demand. There was an overbuilt supply and not enough demand to meet that supply. And Economics 101 tells you, whether you're talking houses, whether you're talking cars, or any type of service or good, if there's a lot of them and not that many people want them, the price goes down. And the exact opposite, why the real estate market booms, is when there's not that much inventory available and a lot of people want that limited inventory. That leads to bidding wars, which leads to an increase in price. Right now, we are simply not in that situation. Supply is a little bit higher than it has been in a couple years simply because the market is somewhat frozen. It is not crashing, but people are not listing their house for sale as much, and people are not looking to buy as much because the affordability is so high right now. It's never cost more money for a down payment. The other variables that go into cost of living had never been higher, and interest rates, while they're not really high, are higher than they have been over the past couple years. So that has led to a pretty frozen market, and there has been a pretty frozen market for the past couple years because supply is so egregiously low. I've seen a lot of different numbers, but most people can agree upon, which most people can't agree upon much these days, that we are about 4 to 5 million houses short for what is needed in the US right now. And you can't just build houses overnight, so we are way behind on supply. So once things kind of even out a little bit and interest rates come down and the cost of living can get under control a little bit more, I'm very confident that house prices will skyrocket once again because the supply is going to be too low because there's just simply not enough houses. The math is the math, and the demand will start to increase as affordability comes down a little bit. Another factor that goes into a crash is the cost of living, as I mentioned earlier, and inflation is a huge part of that. While inflation was out of control a couple years ago, we didn't see a real estate crash because of that supply and demand that I was talking about, and interest rates were lower. While inflation is more under control right now, it's a little bit closer to that 2% target that the Fed wants, we still don't take into account the fact that inflation was high. Now, I'm not an economics professor, but here's what inflation does. It's always going up a little bit, 2 to 3%. We were at 10% there for a while, and it was probably higher than what they actually said. However, we don't get that 10% back just because we're at 2% now. That 10% gain that we had in all our goods and services doesn't go away. We're just building at 2% on top of that huge gain, if that makes sense at all. Hopefully that wasn't confusing. The point is, while the current inflation is around where it should be, that huge spike we had has led to an affordability issue, which can only be solved with a better economy, more money in people's pockets, and lower interest rates. The other thing that can cause a real estate crash out of nowhere would be a black swan event. Something like COVID. The market was going to absolutely free fall, but supply was historically low and still is, and interest rates went down to account for that. or a financial crisis like '08. Now, '08 was caused by real estate, so that was a little bit different, but the dot-com boom and some of the dips in the '80s were not caused by real estate, but they affected real estate. But as you can see, real estate crashes don't, so this is called the Fred median house price chart. Real estate does not go down very often. In fact, it goes up about 95% of years, so people that are predicting crashes every single year are usually wrong. 1 out of every 10 or 15 years, maybe they get to be right, and they'll shove it in all of our faces, but in general, as you can see, real estate pretty consistently goes up in value with minimal dips. All right, now let's talk about why crashes create wealth for those that understand them and that are prepared for them. The 2008 crash created a ton of millionaires and multimillionaires because of the opportunities that presented for those that were ready for them. When the economy and real estate market go into the tank, that creates a ton of distress in all markets, and that obviously bleeds over to the real estate market. If somebody owns a house and they lose their job or have a pay cut or something goes on with their financial situation, they become eventually a distressed seller. And if there's not enough equity in their house for them to tap into or to refinance, or rates are high, they will probably have to sell that house at a discount, which is good for those that are looking to buy houses at a discount. And there is a lot less competition when real estate crashes happen. People get scared, and some people, a lot of people, even with money and the ability to buy the houses at a discount, end up sitting on the sidelines because they're scared. If you're ready to take action, there's going to be way less competition on the retail side and the investing side during downturns. And if you understand creative financing, you can definitely take advantage of a market dip. Creative financing comes in many forms, from owner financing to you talking the owner of the property looking to buy into being the bank, which allows you to have flexibility, lower rates, no credit pull, no down payment necessarily needed, or subject to financing, or sub 2, which is a financing method that allows you to take over someone else's mortgage. This has been a huge strategy for a lot of people over the past couple of years because so many people got low rate mortgages back in 2020, 21, and 22 that they now just sell those mortgages basically, or just allow someone else to take over those mortgages, and the person that's buying that house now has a 3% mortgage when market rate's 7 or 8%. All right, that's why people went into down market. Now let's talk about 4 strategies that you can implement to take advantage of whatever happens over the next 6 to 12 months. Number 1, buy at a deep discount based on current market values. Now that may go without saying, or you may think that it goes without saying, but it does not. If you're able to accurately determine the current market value and you buy at a discount below that market value, the math tells you that even if that market value dips a little bit, you are still able to buy at enough of a discount to still make money and still be profitable. If the market's shifting, like it kind of has over the past couple of years, we just adjust how we buy. When the market was booming, we would buy at 80 cents on the dollar, leaving us a 20% profit margin. Now we're buying at 70 to 75 cents on the dollar, leaving us a higher profit margin. The market's great, we make more money. Maybe we miss out on a deal or two because we can't offer as high. But if the market comes down a few percentage, we're not crushed because we built in some extra equity. And if you think the real estate crashes overnight, you're wrong. The real estate market slowly goes down over time. Like in 2008, 9, and 10, in St. Louis, the market went down about 14% over those 3 or 4 years, which if you do the math is 3 to 4% a year, nothing crazy. Now, of course, real estate is localized and some markets got hit quicker, but your house isn't going to lose half its value overnight. I know people may think it does and the news may tell you it does, but it slowly goes down overnight, mainly because there aren't enough transactions for something like that to happen. The stock market, especially crypto, is priced every second. So you can see it go down and people get scared and everything happens and they panic and they sell. The real estate market's not the same. There aren't near as many transactions every single day, so the pricing and the accuracy of the pricing is not as up to date. And when you're buying deeper, this allows you for multiple exit strategies. If there's a ton of equity when you buy it, you can always wholesale it and mark it up 5-10 grand and sell it to somebody else who's willing to take that risk because you bought it deep enough to mark up. Or you can fix and flip it if you're trying to do the BRRRR method that doesn't work out. Or if you're doing a fix and flip and it makes sense as a rental, you can keep it. The point is, if you buy with a ton of equity, it gives you options and flexibility to take advantage of whatever you need and whatever the market gives gives you. All right, option number 2, I mentioned it a little bit earlier, but this is creative financing. Subject to deals, which is taking over somebody else's loan, has become a lot more popular. Now, part of that is my good buddy Pace Morby's glow up on TV as well as social media and how well he explains this method. But subject to financing has become much more mainstream. It used to be kind of a niche strategy when I came up in the game from like 2014 to 2018 or 19. So it was the perfect storm. People had a ton of historically low interest rates, 2.5%, 3%, 4% on their houses, and interest rates on the existing supply skyrocketed at an historic rate. Now, they didn't go to historic highs, but the rate at which rates increased was historic. So there became this huge gap between what people that owned a house and had a mortgage on it got versus what you could get on the open market. Therefore, these houses and these interest rates became extremely valuable, and people started searching for them, finding them, and getting them under contract. Now, you can look up through a lot of different public data what types of rates people have on properties and go try to find those people, because a lot of people with those low interest rates are doing just fine. But guess what? There's a percentage of them that have a house that's in repair or needs repair, or they are in a situation where they have to sell. And you can come in and take that mortgage over for them, save them from the burden that they're under, and they can move on and do what they want to do, and you can move on and do what you want to do. Seller financing is another great option. This is when the seller becomes the bank. Now, you have to have a unique situation to where the seller is willing to do this, but rather than you using the Burrs method and giving 100% down, or you putting 20% down of your own money, whatever that traditional method looks like, this is the exact opposite of that. I mean, we've done seller financing deals where you put $1 down and you pay the seller back over the next 20 years at $1,000 a month, or whatever the price of the property is divided by 20. You can get this at 0% interest because you don't talk about the interest until the end. If the seller does want a little bit higher interest, you can potentially talk the price down. This just gives you complete control. When you're dealing with a hard money lender, for example, and a small local bank, you have no control. The hard money lender sets the terms and the rates, and the bank sets the terms and the rates themselves. When you're dealing with a home seller or a property seller that is okay with using seller finance terms, you're able to do exactly what you need to do, and hopefully it works out for them, or they're not going to sign on the dotted line. But it's a situation where you can get super flexible. Talk them into this by talking about the tax savings that come along with them. If they're trying to sell you a $500,000 property and they don't owe anything or owe very little on it, they're going to pay at least $100,000 in taxes. But if you pay them that exact same $500,000, or maybe even $550,000, but you pay them back over the next 10 years, they're not paying near as much in taxes because their tax bracket gets lowered. Strategy number 3 is using other people's money. And if you haven't noticed, I talk about all of these strategies in the next one I'm going to give you all the time on this channel. So make sure you're subscribed, because the guidance that I give for free here on this YouTube, A lot of people pay thousands of dollars to learn from other people, but B, these are strategies that work through all market cycles, because these are basic foundational strategies. The wealthy people that you know do the basics brilliantly. They don't chase every little squirrel that runs across from them. So if you do these things, these will help in all kinds of markets, and especially right now. So using other people's money is a huge strategy. I mean, I bought $51 million worth of real estate using other people's money. The main places you're going to want to go is private lenders, because they can be super flexible. They are individuals who lend you money based on your experience with them. And I have several videos on this channel that talk about private lenders. So after this, maybe go check them out. But the point is, private lenders are people that you know that have a home equity line of credit they can pull out, 401k they can borrow against, an IRA they can self-direct. They just have access to some type of probably retirement fund that they probably can't touch for the next 20 or 30 years, but they can pull it out to lend to you if you understand the strategies, which again, I talk about all the time on this channel, and really give a ton of guidance inside my community for my community members on how to raise private funds. Because think about it, if the economy is down and there's a real estate crash, it's probably affecting you to a certain degree, and you might not have as much discretionary income, and maybe you do have the same amount of discretionary income, but you want to save it and cornhole it away for maybe investing in the stock market if that's what you do, and stocks go down and you feel like you're buying at a discount, or maybe just having it for a rainy day. If you're able to use other people's money, the market can be up, flat, down, sideways, or spinning in circles. You're still able to grow and scale at whatever pace you want, because you're not tied or limited to the amount of money you have in your bank account or the amount of money that you earn. Strategy number 4 is getting into recession-proof rental strategies. Section 8 is a great strategy because the government subsidizes the rent for the tenants in the Section 8 programs. Now, contrary to a lot of people's beliefs, they don't always fund 100% of the rent, so the tenant is still on the hook for some rent. However, the government paying the bill for your rent means that if the tenant loses their job, you're collecting all or most of the rent still. So this can be a strategy that helps during recessionary times. Then we have some unique, more new strategies like midterm rentals. Midterm rentals are great because they are used by people that usually aren't near as affected by a real estate crash or a market crash. Like traveling nurses. We always need nurses, and there's always contracts for nurses. Or insurance claims. People that have something happen to their house and they need to move into a property on a midterm basis. Midterm rentals are those 30, 60, 90, 120-day rentals that are given to people that are traveling nurses, corporate leases, people moving from job to job, insurance claims, or even digital nomads. And there are way more people looking for midterm rentals than midterm rentals available. So don't worry if you think it's not something that has enough demand, you're wrong. Just go to Furnish Finder if you've never been there. Look up how many houses or apartments or units are available. There's usually around 250,000 on Furnish Finder. There's 2 million traveling nurses, just to use that one type of job as an example of the supply and demand curve. And then another strategy that I really, really love is house hacking, meaning you buy a duplex, you buy a quadplex or a triplex, and you live in one unit and rent out the others, whether it be something that's already done and rent ready or something you rehab while you're living in it and move unit to unit. It's a great way for you to subsidize some of your owning costs by renting out a portion of the property. Co-living is a thing more on the coast and the Midwest, but co-living is a great option as well, where people are buying bigger houses and renting out by the room, which is obviously affordable for people that maybe don't have money because of a recession. Crashes do not destroy wealth. They redistribute it. So whether we're going into a crash, a recession, a boom, where are you going to sit? Are you going to be where wealth is transferred to, or are you going to transfer your wealth to someone else? I'm fairly confident that if you follow this channel, check out my podcast, The FasterFreedom Show, and follow me on social media, you will be ahead of the curve because I am ahead of the curve and my community is ahead of the curve. And I give you as much of it as I can that the apps allow for free on social media. Now, if you do want more help, just go to the description and click on the link to schedule a call with my team to see if you're a good fit for the community. You may or may not be, who knows, but at least you can answer a couple questions, schedule a call, and see if it works out. If it does, great. I'll personally get to know you and we'll build wealth together. If it doesn't, no big deal. At least you know. All right, hopefully you enjoyed that. If you did, hit that like button, subscribe button if you have not, and check out this video over here to learn how to buy real estate using other people's money. Peace out.